JP Morgan made a major call on gold and then did something that should make every serious market watcher pay attention. They changed their forecast, not by a few dollars, by a massive amount. And yet gold turned around and moved above the very target the bank had just cut. So what is really happening here? Is JP Morgan simply getting the gold market wrong, or is there something much more important hidden inside these changing forecasts? Something about the Federal Reserve, real interest rates, institutional money, central bank buying, and the direction of the global monetary system? Because the headline everyone sees is simple: $6,000 gold. But the real story is much bigger than one price target. Before we break it all down, if you want independent analysis on gold, silver, the Fed, US debt, inflation, and the forces moving precious metals, hit the like button and subscribe to Macro Bullion. Your subscription helps this channel grow, and it tells me you want more independent market analysis without the unnecessary noise. Now let's get into it. A major institutional forecast is not a guarantee. It is a snapshot of what an institution believes based on the conditions it can see at that particular moment. And that distinction matters enormously. The transcript we're analyzing lays out a dramatic sequence. JP Morgan initially had an aggressive gold outlook, then reduced its expectations as monetary conditions changed. By July, the bank had reportedly cut its Q4 2026 forecast from around $6,000 to approximately $4,500, but then something happened that made the entire debate much more interesting. Gold recovered just in your... By late August, the transcript says gold was trading around $4,629 above that reduced $4,500 forecast. And current market reporting also shows gold around the mid-4,500s after a recent pullback, while investors remain focused on inflation and the Federal Reserve's next move. So here's the question I want you to keep in your mind throughout this video. If a major bank changes its forecast and the market quickly moves beyond that revised target, should you focus on the number, or should you study why the bank changed it in the first place? That's the real story. Because gold doesn't move simply because a bank publishes a target. Gold responds to a combination of monetary policy, real yields, the dollar, institutional flows, central bank demand, fiscal concerns, geopolitical risk, and investor psychology. And one of the most important forces in that equation is the Federal Reserve. When real yields rise, gold can face pressure because investors have a stronger incentive to hold interest-bearing assets. When real yields fall, the opportunity cost of holding gold can become less painful. That's why the relationship between gold and real interest rates matters so much. The transcript argues that JP Morgan identified a strong relationship between gold and the 10-year real yield during 2026, with higher real yields creating significant pressure on the metal. But that's only one side of the equation, because while higher yields can pressure gold, there are other forces moving in the opposite direction. Central banks have continued to accumulate gold. Reserve diversification remains a major theme. Fiscal concerns remain significant, and investors are still watching whether monetary policy eventually becomes more supportive of precious metals. Recent market coverage also shows that gold's August rally has been linked to concerns about U.S. fiscal sustainability, the dollar, central bank demand, and expectations surrounding monetary policy. So the real battle isn't simply $4,500 versus $6,000. The real battle is between competing forces: higher real yields versus monetary easing, institutional selling versus renewed ETF demand, a strong dollar versus currency diversification, short-term Fed pressure versus long-term fiscal concerns. And that's why JP Morgan's changing forecast is worth studying, because the forecast itself may be less important than the variables behind it. If those variables change again, the forecast can change again. And if gold continues moving ahead of conservative institutional targets, the market may be telling us that some of those assumptions are changing faster than expected. But there is a catch. A move from roughly $4,600 towards $6,000 would still require a very substantial rally from current levels. The transcript itself emphasizes that $6,000 by year-end is possible, but far from guaranteed, because the market would need a combination of supportive monetary conditions and renewed institutional demand. And that is exactly where this story gets interesting, because if gold reaches $6,000, the obvious question will be, how did we get there? But the better question is, what changed before gold got there? That's what we're going to investigate next. The most important thing to understand about JP Morgan's changing gold forecast is that the bank didn't simply wake up one morning and decide that gold was worth less. The underlying conditions changed. And when those conditions changed, the forecast changed with them. That's how serious institutional research is supposed to work. Think about it this way. A price target is not a promise about the future. It's an estimate based on a particular economic environment. Change the interest rate outlook and the target can change. Change real yields, and the target can change. Change institutional demand, ETF flows, central bank buying, or the dollar outlook, and the target can change again. This is why focusing only on the headline number can be misleading. The much more important question is, what changed underneath the forecast? According to the source material, one of the biggest changes came from the Federal Reserve. When expectations for higher rates increased, real yields moved higher. That created a stronger opportunity cost for holding gold because gold itself doesn't generate an interest payment. And this is where gold's relationship with interest rates becomes critical. Imagine an institutional investor deciding between two assets. One is gold, the other is a government bond offering an attractive yield. If inflation-adjusted bond yields rise substantially, the investor has a stronger financial incentive to hold the bond. But if real yields decline, that advantage becomes smaller. Suddenly, the opportunity cost of holding gold falls. This is why every serious gold investor watches the Federal Reserve. Not because the Fed controls gold directly, it doesn't. But Fed policy influences the cost of money, treasury yields, the dollar, liquidity, and ultimately the attractiveness of non-yielding assets. And right now, that relationship is still front and center. Recent market reporting shows gold trading around the mid-$4,600 area, while investors await Federal Reserve Chair Kevin Warsh's comments at Jackson Hole. Markets are watching closely because expectations for future rate hikes can create pressure on gold, while concerns about fiscal deficits and dollar debasement can support it. That creates a fascinating tug-of-war. On one side, you have higher rate pressure. On the other, you have concerns about debt, fiscal sustainability, central bank demand, and currency purchasing power, and gold is sitting directly in the middle of that battle. But there is another force that could become just as important: institutional flows. The source material says JP Morgan dramatically changed its expectations for gold ETF flows, moving from an expectation of net inflows toward an expected net outflow. That matters because large institutional investors don't necessarily buy physical gold bars and coins. They can gain exposure through financial products such as gold ETFs. When billions of dollars move into or out of those products, the effect on market demand can be substantial. And this is why a change in ETF flows can completely alter a bank's near-term price forecast. But here's where the story gets interesting. While some institutional investors can become sensitive to interest rates and short-term returns, central banks can operate on an entirely different time horizon. They're not necessarily asking, where will gold be next month? They're thinking about reserves, currencies, diversification, long-term financial stability. And according to the source material, central banks continued buying gold even during periods when prices were falling. That creates an unusual situation. One group can be selling because yields are attractive. Another group can be buying because it is thinking in decades. And when those two forces meet, the gold price can behave very differently from what a simple interest rate model might suggest. This may explain why gold has shown such resilience. Recent reporting says central banks bought roughly 289 tons of gold during the second quarter while prices were falling, followed by a sharp August rebound. So now we have two very different clocks operating inside the same market. The first clock is short-term: Fed meetings, inflation reports, treasury yields, ETF flows, dollar movements. The second clock is long-term: reserve diversification, fiscal sustainability, central bank accumulation, and changing confidence in the global monetary system. The short-term clock can push gold down. The long-term clock can continue creating demand underneath the market, and that is why gold can fall sharply without necessarily destroying the long-term bullish thesis. It also explains why a correction doesn't automatically mean the entire gold story is finished. But there's an important warning here. The long-term story can be bullish while the short-term price can still fall. Those two things can exist at the same time. That's something investors often struggle to understand. A bullish long-term thesis does not mean the price must rise every week. It doesn't mean every correction is a buying opportunity, and it certainly doesn't mean a $6,000 target is guaranteed. In fact, the source material itself presents a downside scenario in which higher rates and stronger economic data could push gold significantly lower before any later recovery. That is exactly why we need both sides of the story. The bull case is powerful, but the bear case is real. And the next major question is whether the forces supporting gold can overpower the forces pushing against it. Because if real yields remain elevated, institutional money could continue favoring bonds. But if the Federal Reserve eventually becomes less restrictive, the dollar weakens, ETF flows reverse, and central bank demand remains strong, gold could have a completely different environment. And that is where the $6,000 question becomes much more interesting. Not because a bank printed the number, but because the entire monetary environment would have to move in a direction that makes that number increasingly achievable. So before we decide whether $6,000 is realistic, we need to examine the three forces that could potentially drive gold toward that level, and the three forces that could stop it. Now we get to the part that could determine whether the $6,000 gold story becomes reality or remains just another ambitious forecast. There are three major forces that could push gold substantially higher, and there are also three forces that could stop the move. The first bullish force is institutional demand, the second is central bank buying, and the third is the monetary environment, particularly what happens to real yields, the dollar, and Federal Reserve policy. Let's start with institutional demand. Gold doesn't need every investor in the world to suddenly become bullish. It needs enough large pools of capital to move in the same direction. That's why ETF flows matter. When investors allocate money into gold-backed exchange-traded products, that demand can reinforce the physical and financial market. And recent market reporting has shown renewed ETF demand supporting gold's August rebound. But this is also where the story can reverse. If investors decide that bonds, equities, or other assets offer better risk-adjusted opportunities, money can flow back out. And when institutional flows reverse, gold can experience significant short-term pressure, even if the long-term thesis hasn't completely changed. That's the first major lesson. A bullish gold market still needs buyers. Now let's move to the second force, central banks. This is one of the most important structural developments in the gold market because central banks operate differently from short-term traders. They're not necessarily trying to capture a few percentage points from a monthly move. They're managing reserves. They're thinking about diversification. And they're considering how their reserve assets behave over much longer periods. Recent reporting has highlighted continued central bank demand as one of the supports underneath gold's current strength. This matters because central bank demand can provide a different source of support than speculative buying. But even here, we need to stay realistic. Central banks are not guaranteed to buy at any price. Demand can fluctuate, and central bank buying alone doesn't guarantee a $6,000 gold price. The third force is where things become even more interesting: real yields. This is the variable that can dramatically change the opportunity cost of holding gold. If inflation-adjusted yields rise, gold can become less attractive relative to interest-bearing assets. If real yields fall, the pressure can ease. And this is exactly why the Federal Reserve remains so important. Right now, the market is watching Fed policy closely because inflation remains above the central bank's 2% target, while investors are trying to determine whether rates could move higher later this year. Reuters reported that markets were pricing a meaningful probability of a September hike, while gold remained near the $4,600 area. So we have a contradiction. Gold is dealing with the traditional headwind of potentially higher interest rates, yet it is also benefiting from concerns about fiscal sustainability, dollar purchasing power, central bank demand, and investor interest in the so-called debasement trade. And this contradiction may be one of the most important things happening in the market right now, because gold is showing resilience even while some of the traditional macro conditions are not perfectly supportive. That tells us investors may be looking beyond the next Fed meeting. They're looking at the bigger picture: debt, deficits, currency risk, reserve diversification, and the possibility that governments may eventually face difficult choices between fighting inflation and maintaining financial stability. But now we have to talk about the bear case, because if you're going to take a $6,000 forecast seriously, you also have to take the risks seriously. The first risk is obvious: higher for longer interest rates. If inflation stays stubborn, the Fed could remain restrictive. If real yields rise further, gold could come under pressure. The second risk is a stronger dollar. Gold is priced in dollars, so a stronger US currency can create another headwind. And the third risk is a reversal in institutional positioning. If ETF investors continue taking money off the table, the market could struggle to maintain upward momentum. This is why the next phase may be extremely volatile. Gold can remain structurally supported while experiencing sharp corrections. And we're already seeing that volatility. Gold dropped more than 1% on August 26th after U.S. inflation data reinforced expectations that the Fed could potentially raise rates. Then, on August 27th, gold recovered toward the $4,600 area as investors shifted their attention toward Fed Chair Kevin Warsh's upcoming comments and continued concerns about fiscal sustainability and dollar debasement. That is the market we're dealing with. One day, inflation and rates dominate. The next day, debt and currency concerns take over. And gold responds to the balance between them. So what would actually have to happen for $6,000 to become realistic? The answer is not one magical event. It would probably require several forces to align. Real yields would need to become more supportive. Institutional demand would need to strengthen. Central bank demand would need to remain resilient. The dollar would need to avoid a sustained surge. And investors would need to continue viewing gold as protection against monetary and fiscal uncertainty. If several of those conditions happen simultaneously, the path toward $6,000 becomes easier to imagine. But if the Fed remains aggressively restrictive, real yields climb, the dollar strengthens, and ETF flows weaken, gold could struggle instead. That's why the real question isn't, will JP Morgan's $6,000 target come true? The better question is, are the conditions required for $6,000 beginning to appear? And that brings us to the final part of this analysis, because there is one more factor that could completely change the equation: the difference between a normal gold rally and a genuine monetary revaluation. If we're entering the second type of environment, then the numbers being discussed today could eventually look very different. But if we're simply experiencing another powerful cyclical rally, chasing the highest forecast could be exactly the wrong strategy. And that is where the $6,000 debate gets really serious. The $6,000 gold question now comes down to one thing: what kind of monetary environment would we need to see for gold to make that move? Because a number on a research report doesn't create a bull market, the underlying conditions do. And if we look at JP Morgan's own research, the $6,000 target is not presented as an unconditional guarantee. The bank's outlook is tied to factors including Federal Reserve policy, investor demand, fiscal concerns, geopolitical fragmentation, and the broader debasement narrative. That distinction is critical. Imagine the Fed stays restrictive for longer than markets expect. Real yields remain elevated. The dollar strengthens. ETF investors remain cautious. Under that scenario, gold could struggle to sustain a move towards $6,000. But now imagine the opposite. Real yields begin falling. The dollar loses momentum. ETF demand accelerates. Central banks continue accumulating. And investors become increasingly concerned about fiscal sustainability and the long-term purchasing power of currencies. Suddenly, the same $6,000 target looks much less extreme. This is why professional investors don't simply ask whether a target is bullish or bearish. They ask, what assumptions are embedded inside the target? That's the real analysis. And one of the biggest assumptions is ETF demand. The World Gold Council's 2026 data shows that gold ETF flows have remained an important indicator of investor positioning. Even though June saw outflows across regions, global holdings remained higher year to date, with total holdings increasing during the first half of the year. So if ETF demand starts accelerating again, that could become a major catalyst. Why? Because the gold market doesn't need every investor to become bullish. It needs marginal demand to increase. When large pools of capital start moving toward gold, the price can respond disproportionately because the available supply of investable gold doesn't instantly expand just because demand rises. And that's where a potential feedback loop can develop. Higher prices attract attention. Attention brings new investors. New investors create additional demand. Additional demand pushes prices higher. Higher prices create even more headlines, and suddenly an asset that was ignored becomes one of the most discussed markets in the world. But this process works in both directions. If investors lose confidence in the trade, flows can reverse. And that's why ETF demand remains one of the key variables to monitor. There's another variable that could become even more important. The dollar gold is priced in dollars. So when the dollar weakens, gold can become more attractive to investors holding other currencies. But the dollar isn't simply a currency chart. It is also a reflection of confidence in the broader U.S. financial system. And that brings us back to fiscal policy. Debt, deficits, interest costs, government borrowing. These issues don't automatically mean a currency crisis, but they can influence investor behavior. JP Morgan's own research identifies fiscal risks, purchasing power concerns, and geopolitical fragmentation among the structural themes supporting gold's longer-term outlook. And this is where the gold story becomes bigger than inflation. Gold isn't only an inflation trade. It can also become a diversification trade, a reserve asset, a geopolitical hedge, a store of value, and potentially a hedge against uncertainty surrounding the financial system. That's why central bank behavior matters so much. Central banks don't necessarily operate with the same short-term objectives as hedge funds or individual traders. They can accumulate reserves for strategic reasons. They can think in years rather than weeks. And when strategic buyers continue accumulating while short-term investors become nervous, the market can develop a very unusual structure. Short-term positioning can be weak, yet long-term demand can remain strong. That is one reason a correction doesn't automatically destroy the structural bull case. But there is a major danger in this argument. Investors can become so convinced about the long-term story that they ignore short-term valuation and risk. That's where a good thesis can become a bad investment decision. You can believe gold has a strong long-term future and still buy at the wrong time. You can believe the monetary system is changing and still overpay for an asset. You can believe $6,000 is possible and still suffer a major drawdown before the market ever gets there. That's why the path matters, not just the destination. JP Morgan itself has acknowledged that the route toward its year-end target is increasingly dependent on how rates are priced. Its mid-year outlook says the structural bullish drivers remain intact, but the possibility of Fed rate hikes has made the near-term environment more difficult for precious metals, and that may be the single most important takeaway from this entire story. Gold can have a bullish destination while facing a difficult journey. That means investors should not confuse a long-term forecast with a short-term trading signal. The market can fall, it can consolidate, it can overshoot, it can reverse, and then if the underlying conditions eventually become supportive, it can resume the larger trend. That's why the $6,000 target should be viewed as a scenario, not a promise. And if we eventually see the combination of lower real yields, stronger ETF demand, persistent central bank buying, a weaker dollar, and escalating fiscal concerns, the probability of a much higher gold price could increase. But if the opposite happens, the market could deliver another painful correction. So we're left with one final question: what should investors actually watch from here? Not the headline, not the prediction, not the number printed on a bank report. Watch the signals, watch real yields, watch the dollar, watch ETF flows, watch central bank purchases, watch Fed expectations, and watch whether the market begins rewarding gold even when traditional macro conditions are working against it. Because if that starts happening consistently, it could be a sign that something deeper is changing. And if that deeper shift continues, the debate may eventually move beyond whether gold can reach $6,000. And it could become a question of whether $6,000 was actually the beginning of a much larger monetary repricing. So now we can answer the question that matters most. Can gold actually reach $6,000? Yes, it is a plausible scenario, but it is not a certainty. JP Morgan's own published outlook expects gold to push toward $6,000 per ounce. But that forecast depends on the economic and monetary conditions supporting continued demand. And that distinction is critical. A forecast is not a guarantee. It is a scenario built around assumptions. If those assumptions change, the target can change too. That's why I don't want you to walk away from this video thinking JP Morgan said $6,000, therefore gold must reach $6,000. That's not analysis. The better question is, what would have to happen for gold to reach $6,000? First, we would likely need a more supportive interest rate environment. If real yields begin falling, the opportunity cost of holding gold becomes less restrictive. Second, institutional demand would need to strengthen. ETF flows are particularly important because they can bring large pools of investment capital into the gold market. Third, central bank demand would need to remain strong. That is one of the structural forces behind the long-term gold story, and recent research continues to identify central bank buying as an important source of demand. Fourth, the dollar would need to avoid a sustained period of significant strength. And finally, investors would need to remain concerned about fiscal sustainability, purchasing power, and the broader monetary environment. If several of those conditions line up at the same time, the $6,000 scenario becomes much easier to understand. But there is another side. If inflation remains stubborn, the Federal Reserve stays restrictive, real yields move higher, and institutional investors continue reducing gold exposure, the market could struggle. Gold could correct, it could consolidate, and it could spend a long time frustrating investors before the next major move. That is why chasing a target is dangerous. The market doesn't move because you believe in a number. It moves because capital changes position. And that is the real lesson from JP Morgan's changing forecast. The bank's target isn't the story. The assumptions behind the target are the story. If those assumptions become more bullish, the target can rise. If they become more bearish, the target can fall. And that's exactly why we should be watching the underlying indicators rather than obsessing over one headline. Watch real yields, watch treasury yields, watch the dollar, watch ETF flows, watch central bank purchases, watch Fed expectations. And watch how gold responds when these variables change. Because here's something extremely important. If gold continues holding firm even when real yields and rate expectations create pressure, that could indicate that other forces are becoming powerful enough to offset the traditional headwinds. That would be significant. It would suggest that the market is increasingly focused on longer-term concerns rather than simply the next Fed meeting. And if that trend continues, the debate could move beyond $6,000. We could eventually be talking about whether the current gold cycle represents something much larger than a normal commodity rally. But we shouldn't get ahead of ourselves. There is still a real bear case: a stronger dollar, higher real yields, persistent inflation, reduced ETF demand, and a Federal Reserve that stays restrictive for longer than investors expect. Any combination of those factors could create substantial volatility. So the responsible conclusion is not, gold is definitely going to $6,000. The responsible conclusion is $6,000 is a scenario worth watching, and the conditions behind that scenario are what investors should monitor. And that's also why the recent price action matters. Gold has remained around historically elevated levels, while markets continue debating rates, inflation, fiscal policy, and central bank demand. Recent coverage continues to describe the metal as supported by a combination of investor demand, central bank buying, and broader fiscal concerns. So whether you're bullish or bearish, don't let a single price target do your thinking for you. Study the evidence, follow the money, understand the macro environment, and most importantly, keep your expectations realistic. Because the biggest mistake investors can make is turning a forecast into a promise. JP Morgan can be right, JP Morgan can be wrong. The market can overshoot the target, and the market can fall far below it. And the path between today's price and any future target could be far more volatile than the headline suggests. That is why this story isn't really about $6,000. It's about understanding what drives gold when the financial environment changes. And if those drivers continue moving in gold's favor, the market may eventually force investors to rethink what they consider a high gold price. But if those drivers reverse, the same investors celebrating the next rally could suddenly discover why risk management matters. So don't chase the number. Watch the conditions, watch the Fed, watch real yields, watch the dollar, watch institutional flows, watch central banks, and then make your own judgment. Because the smartest question isn't, what did JP Morgan predict? It's, what is the market telling us now? If you found this analysis useful, hit the like button and subscribe to Macro Bullion. And tell me in the comments, do you think $6,000 gold is a realistic 2026 scenario? Or does the Fed still have enough power to stop the move? This is independent market analysis for educational and informational purposes, not personalized financial advice. Always do your own research before making financial decisions. And remember, don't just watch the gold price, watch the forces behind it.